So welcome everybody to the 4 Stars Today's Market Explained podcast and video series. And we have some really special guests today. The markets are crashing. The bond market, stock markets are crashing, bond markets are crashing. And we're turning our discussions today to real estate. And we have two of the top real estate investors and strategists and program sponsors with us today. We have Mr. Bill Shopoff, the leader and founder of Shopoff Realty, and his chief strategy officer, Daniel Oschin. And we're very proud to have you guys. So both of you, welcome to the 4 Star Wealth Today's Market Explained podcast.
Thanks for having us, Brian. We're very happy to be here. Looking forward to the discussion. I think it's a very interesting time in the market. Just as a way of introduction, I want to make sure everybody has a chance to meet Bill Shopoff. He's our president and CEO. He founded Shopoff Realty Investments in 1992. So we're celebrating our 30th anniversary this year. The company focuses on opportunistic and value-add real estate, finding ways to create and generate value through our efforts. We're primarily in the business of areas of real estate where we have an effect and control to some degree of the outcome, including land entitlement work, commercial repositioning, and development. Bill is a long-time creator of value. He's also a philanthropist, a father, a good friend of mine, and an extraordinarily well-respected member of the real estate community. And I'm just honored today to have the opportunity to work with him on this podcast. So thanks for having us, Brian.
Thanks, Daniel. Thanks for formally introducing Bill. Why don't we take it from here? Welcome, Bill.
Thank you very much, and thank you, Daniel, for the kind words.
We're proud to.
I'll send the $10 over later.
Thank you. Well, excellent. Well, speaking of Shopoff and your experience, maybe you could share with us a little bit about Shopoff, the company, as you did, Daniel, partially, and let's understand where you guys are coming from, so we have a base for the discussion going forward.
Well, as Daniel said, I started the company 30 years ago. I had 3 partners, and we founded the firm. Originally, it's called Asset Recovery Fund, and we were buying distressed and opportunistic properties in the RTC, FDIC era, and we've transitioned that business over time, and we founded it in Austin, Texas. We relocated here to Southern California 21 years ago. So the demise of California, at least in my opinion, is overrated, and we'll get into that. But we've continued the same core focus, less distress. The world's gotten more efficient, and so distress hasn't happened as frequently. There's still opportunity, but we have found great opportunity to see things that others don't see and create some value. In what our hope and desire, and I think we've accomplished most of the time, certainly not every time, is to create outsized returns without taking outside risk.
Right.
We think the thing about the real estate market is, unlike the stock market, where there is essentially perfect information, occasionally there's in the imperfect information is illegal generally. So in our business, it's not illegal to trade on insider information. So if I hear of something, I can go position myself to take advantage of that. We did that. We did that. We got wind that the NFL was considering a team in Inglewood, and we bought a site 0.3 of a mile from the stadium. We had information that others did not have, and we profited nicely on that trade. In a trade where people, and by the way, we profited nicely, and we sold way too early. The people we sold to made way more money than we did, because they didn't just buy the news. They actually waited for a stadium to get built and sold houses for more money than anybody could ever imagine in Inglewood. So I think that sometimes seeing structural changes are useful, and that's one of the things we've been able to do. But look, we've been proud to be able to work with thousands of people over the last 30 years, and make individual changes in people's lives based on their decision to work with us. And I think that's the thing I'm most proud of.
Nice. Nice. Now, I understand you and the organization, Bill, have purchased over 1,000 different properties over the years, and then you package them into different programs for those investors that have all benefited from your experience and knowledge. Tell us a little bit about how that's all organized, if you would.
Yeah. So initially, we did a lot of single purpose assets. We just buy an asset, fund it with our, and originally we started with what we would classically call family and friends. Over time, that got into institutional relationships, which we still continue to this day. But we bridge between just a purely institutional relationship or just working with high net worth, and we've created products that provide the opportunity to do both. So we have both a fund strategy as well as today we've kind of reverted back to some individual offerings from time to time to really provide maximum flexibility for you, the advisor, to be able to figure out the best place for, how does that work in a client's portfolio? Look, somebody who has a very large portfolio, I think is better suited. They can do one-off deals because they can build, you can help them build their own portfolio.
Right.
So they're not taking one-off risk. They're not betting all on black. Because look, I love each of my deals. They're like children. I don't have a favorite deal, but occasionally one deal works better than the other. But I think that what we never want is everybody to put all their eggs in one basket.
Right.
So we built the fund approach for people who maybe they don't want to deal with looking at individual deals. They want to make a single decision and say, look, we trust Daniel and Bill and their team, and we're going to write our check and we're going to get exposure across a broad platform. Then we've got other folks who said, look, we're tired of funds. We want that. So we've tried to offer both. And we think that's an interesting way because some clients, they're way better off in the fund. Other people want to really kind of understand the real estate. They want to feel like they can touch it and understand it and make a decision to go into, deal A or deal B. But look, we've been doing this for a very long time. I hope we continue to do it for a very long time. As Daniel said, it's 30 years. I mean, there's not a lot of businesses that last that long. And, I think we're on the best trajectory and foundation that we've been on ever in our business. And I'm very excited about where we are.
Nice. Well, and I noted your prowess on that land deal by the new stadium. And I noticed also that you're part of the Urban Land Institute. I know that some of the earlier programs were just land deals, the Shopoff land deals. And then you've done shopping centers, you're doing hotels, you're involved in a lot of different things. So it's going to be interesting to hear more. We are talking today near the end of the pandemic. I think everyone pretty much agrees the pandemic is over with a little bit of residual things going on and a lot of effects still in the economy. So what do you make of all this? I mean, real estate's been hotter than a pistol and it's gone parabolic, and commercial hasn't been as good because people aren't going back to cities. And I mean, it's just like a swirling, controversial set of facts. Could you just give us a sense of what's really going on in the overall real estate market now?
Hey, Brian, I have to tell you, if, looking back, I mean, March of 2020, when our governor shut the state down, I got pretty panicked. I was like, boy, is this going to be another great financial crisis? And I didn't really think about whether the government was going to step up and, solve some problems, which, I'm not usually a big fan of the statement, the government is my friend and they're here to help me. But, I would say the initial money that they put out was essential. We could argue whether the subsequent money, I think, was not essential. And it's why we're having, I would say the money put out in early 2021 is in big part responsible why we're having this inflationary issue. And I grew up, I was young, but my dad was a corporate executive during the inflationary period where we had price controls. And, I was telling somebody earlier in the day, my dad would come home and cuss the president. And he wasn't that kind of guy. He was really kind of apolitical. He voted, but he didn't really get that ingrained in it like some of us do today. But I've known it could happen, and so I was kind of wary of it. But look, it's been a great run for us. Not every one of our properties has been a winner, by the way. We own some kind of generic suburban office. We're going to sell one of our buildings here shortly, and we're going to take a hit on the building. But we just don't see upside for that product. And so, I'd rather take the hit today than prove I'm right and be here 2 years from now. At least I can take the capital we've got and go redeploy it and kind of make up for where I am.
Right.
So we've sold a number of assets. We've been kind of retooling our portfolio. And candidly, so I'll tell you my surprises. Retail's outperformed office, even though we've been a buyer of office buildings during the pandemic and actually resold one of them recently and almost doubled our equity in less than a year and a half.
Wow.
Because we bought it in the pandemic. We bought it at a good price with a good story. We did some financial engineering on it and did a very creative structure by creating new ground leases and carving 3 buildings that were sold together, but carved them and sold them individually. And we'll have all 3 of them sold before the end of the year, I feel certain. One's sold, one's in escrow, and the other one is getting knocked around by buyers. And we're selling those at, I think, exceptionally good cap rates. 5.3 cap rates on office product. Even in this market, I mean, we just closed one a week ago, and we just opened escrow on a second one at that kind of pricing. So, still the exchange buyers still active in the marketplace. Single family, like lights out, like never would have forecasted it being as good as it was. We've sold land during the pandemic at record prices. Our pipeline remains robust. Multifamily, we stuttered early in the pandemic. We were doing a lease up on a new building, and we were leasing 15 units a week. And then mid-March happened, and we didn't lease anything for 6 weeks. And then we raised rents and leased the rest of the building, and now rents are probably 25% above where they were in March of 2020.
Wow.
And so I think it's been kind of a crazy time. And then I'll say the last thing that really has been the most astounding, and I'd say where we've had incredibly good fortune, we also got into we were in the business, but we decided to make a big move into the warehousing logistics space. Mm-hmm. And we've been extremely well rewarded for that. We've got our first buildings are nearing completion. They're already sold. They sold it, I don't know, Daniel, what would you say, 25% above target?
Yeah.
And so those will be delivered at the end of this year. We're delivering returns on that are, I think, the deal level. Obviously, I'm talking about existing deals and not forecasting what we can do, but that deal's going to be a 70% IRR on a very large amount of capital. And, I think that those have been great runs for us. So even though the stock market was doing great, we were beating the stock market across most of our deals. And we didn't pro forma them, the deals we're buying. We're not like, this can't continue. We get windfall, we get windfall. But I think that, look, the real estate market's got to moderate like the stock market. We're going to see some pullback in value, certainly in value rise, maybe some pullback in value. But it still feels like a very good place to be. Look, rents in a lot of product they have to work hand in hand in inflation, or no product doesn't get built, because construction costs are up, land costs are up.
Right.
And if you need a new building, I can build it for you, but you're going to pay for the rent pays a yield on that. Mm-hmm. So I think that things feel very good, although we know they're going to pull back. But I'm okay with a pullback. It wasn't really sustainable.
Yeah, it was quite a market. Well, Bill, you mentioned the industrial projects. I know you're doing some in Las Vegas, but also in Las Vegas, I understand you're doing a hotel project, and Four Star has some hotel programs on their platform. But we did raise the risk profile from just kind of standard pure income and growth to more growth oriented because of the complete meltdown in the pandemic and hospitality. But now there's opportunity there, it seems. What would you say about that? And tell us about your dream hotel project.
Look, hospitality has been an interesting play because select service did pretty well and resort did extremely well. Resort hotels are probably at 2x their EBITDAs where they were pre-COVID on a whole. Daniel and I lament about it every day when we plan to go on a trip, and between airfares massively inflated, but it wasn't that long ago, Brian, that $1,000 hotel room was a big deal.
Right.
Like I didn't go, like I'm a pretty well-to-do guy, and I didn't go to $1,000 hotel room very often. And now it's standard fare. And by the way, the thing that's always stunning to me is I go check in, and then I look at the 20 and 30 somethings checking in next to me, and I'm like, what the heck? Like where did they get their money from?
Exactly.
So I think hospitality, where I think hospitality is still suffering, downtown business hotel, business traveler, that's still in lag. I think it comes back. But look, I think so. Dream Hotel. I remember in May of 2020, my land lender on the Dream land was telling me how completely stupid I was. He's like, people are never going to travel again. Nobody's ever going to Las Vegas again.
Right.
And he's like browbeating me about how stupid I was. And I said, look, I know one thing about humans. Humans like to congregate, and humans like to party. Right. And humans have come back to Las Vegas. What's not back in Las Vegas yet is the business traveler. Convention businesses back to, I don't know, Daniel, what are our stats? Maybe 50% back?
No, it's a little better than that. But it's trending towards, by the end of this year, it should be above 85%.
Yeah. But what's back is the individual traveler is beyond where they were in 2019. So ADRs are up citywide. Occupancies are up. It's hard to find a room. So when the convention business comes back, I think those values continue to move. Our Dream Las Vegas project, we did not really move those room revenues up in our forecast. So I think we've got some surprise to the upside. We're very excited about the project. We're breaking ground next month. Still raising a little bit of capital, but moving quickly. And we're very excited about what we think is the upside of that project. If we hit our forecast, we're thrilled. We've got a nice 10-year run, QOZ, got the tax benefits of an OZ. But as I tell people, the tax benefits are useless if you don't have a good investment.
Right.
I can tell you, I can tell you the number one way to save taxes: lose money, lose your gain. You don't have to pay any taxes. So that is not the solution. The solution is we put your money to work and we make some more money, and then you don't pay taxes. Then it's a winning proposal. Good tax strategy will make good business decisions better, but good tax strategies never fix a bad deal.
Yes.
And so we're really focused on the real estate and operational expertise. We're thrilled to have Dream as our operating partner. We've actually just secured. We're not quite ready to name our gaming partner yet, but we have secured a deal for a gaming partner, and it's a group with a good database, They'll be able to drive, our occupancy and drive that revenue from the gaming, even though the investors in our OZ are not technically in the gaming component. They do benefit from it through, getting that revenue up, contributes to some rent revenue. I'm happy about it because I am part of the gaming. I'm getting a gaming license, and so I'll get a little bit of benefit of that. It's just relatively small amount, but it's pretty good return on my dollars. If you told me, by the way, that I was going to build a hotel on the Strip and get a gaming license, I'd have said never going to happen. And I've just given up saying never, Brian, because the world changes and you have to evolve with the world. And I think our business, like you look at our portfolio, we're buying broken shopping centers. We're doing, a 4-star hotel in Las Vegas over Daniel Schulter's, the rendering, doing industrial. I'm doing build to rent. I'm doing luxury condos. I mean, it's about as diverse a book as I've ever had in my business. Yet each one of them has a reason we should be doing it. And there's a story behind each project as to why we like it.
Nice. Well, and we have a number of your projects on our platform at 4-star. So for full disclosure, and we have investors with Shopoff as well. What other trends do you see happening? We've seen, hotels now are emerging and going to come out. Commercial's still struggling. Any comments in any of that? Like, is commercial going to recover?
I think you're going to see. Let's talk about commercial and two.
Yeah.
Let's break it into retail. We've segregated out industrial, but you got retail. I think retail, there's winners and losers in retail. Look, good retail is going to continue to thrive. You'll see, some new retail development, and I think it'll continue to do well. But it's going to have to be well located and well executed. We think that bad retail will continue to get repurposed into some other use. We are one of the market leaders in that. We're buying, end caps on malls. We're actually trying to buy. We're in the process of buying a mall today to repurpose for, residential and last mile logistics. But I think what that does for us is it allows the marginal retail is going to get better because we're going to remove some of the retail. And if we took 25% of the retail out of America and repurpose that land, then we'd have healthier other centers. So I think retail is going to be fine. Look, the retail is continuing to grow. It's just the majority of the growth in retail is e-commerce.
Right.
So, which is driving the industrial business. Then you go to the office market. I think it looks like you're in your office. I'm in my office today.
Right.
I'm in my office most every day.
Yeah.
But I have to tell you, I have to, bribe may be too strong a word, but I'm buying people lunch 2 days a week to get them to come to the office. So, or throwing a party like we did last week. So we're doing some things to get people here. I believe people are going to come to the office, but I think they want a better office experience. We relocated our office a few months ago to a newer, cooler space, and I think it's generally been very well received by our employees and exceptionally well received by our customers and our vendors. I think if it's generic kind of suburban office, I think that stuff's got a tough road ahead of it. Yeah. I think there's going to be a lot of repurposing of those buildings. I think as those loans come due over the next few years, I think there's going to be some hardship, and there will be some distress in that space.
Yes.
So I think that good high quality office. We're probably in one of the best buildings in the market. I think it's going to be fine. Daniel owns an office building, well located in the Mid-Wilshire corridor. That building's going to do fine long term. It's still going to go through some bumps. They're going to have to deal with moving some of their retail around. But where he's gotten hurt is, for the last 2 years, that's a building where paid parking was a big part of their revenue.
Right.
And I don't want to rub salt in it, but Daniel, how much cash flow have you guys lost from just parking alone?
Well, parking represented about 10% of the total revenue, but
Wow.
incrementally, it represented about 60% of our distributable cash flow.
Yeah.
Retail being the balance between retail being mostly vacant and parking being down about, at the worst of it, 90%, but even now 70%, and office occupancy being down, not proportionally, but additionally. We're sweeping what cash flows we have to pay for tenant improvements and leasing commissions. You have to have a very long-term outlook for office if you're going to be in this kind of office product. But we've owned it a long time. We'll be fine. But as Bill said, the market's coming back for office. It is already back in some areas. It depends. It's niche, it's neighborhood, it's understanding market dynamics. The benefit we have, and Bill didn't mention this, but our property is not a brand new top of the line maximum rent. And what you're getting right now is people moving into one or two locations. They're either willing to pay less for the best of what there is, or they're looking to make a move into something less expensive and in many cases reduce their footprint. And so we're in a good position to handle that, but we're just now starting to see people come back to the market looking for leasing in the area we are.
I mean, when we look at the amount of sublease space across the country, it just feels like office is going to be under pressure for a while. Look, I think ultimately people are going to go back to work in some kind of hybrid situation in most businesses. Footprint will change. Some businesses will be smaller. We need to go larger. We took about the same amount of space, and I would tell you, we probably wish we'd taken a little more, but we took a sublet and got good pricing and got a great space. But I think that I will buy office, and we are buying office. In fact, we're buying a building right now to repurpose our second deal to buy an anchor at a mall and repurpose into office. We've got a site in Austin, Texas that we're tying up, and it's a former J.C. Penney's. I guess it's actually an existing J.C. Penney's, but they want out. Great location in Austin. It's a market that obviously I know. I lived there for 25 years and founded the company there, so I know a little bit about it. And that's a market where office is still doing extremely well.
Right.
People are paying big rents, but I think there's even concern there. So we do. You just have to be cautious about it. So.
Yeah. You mentioned Texas, and we talked a little bit about Nevada. Obviously, you guys are the kings of California. Are there other markets too that you're looking at doing work in, or mostly in those?
We're in Nevada. Clearly, we do the majority of our work here in California. Mm-hmm. We actually have a pretty significant exposure in the Phoenix market, and that's growing right now. We own some property there. Just acquired some stuff in late last year, but we have 4 sites under contract right now. Right. Mostly in the warehousing logistics space, because we saw the market jump in rents in California, and the natural progression was going to push some of the tenants who are price sensitive. We're going to push to that Phoenix market.
Okay.
Drive that market, and it's in our prognostication has been accurate. So we've got some nice land positions there that we'll be developing out. We've got one transaction we're knocking around in Colorado. We occasionally look in the Texas market. We have looked at other markets, but I would say our core focus is Arizona, Nevada, California, occasionally Colorado, occasionally Texas if we saw the right opportunity. Okay. We're underwriting a pretty nice opportunity in Texas today. I think for us, it's hard to service it to go further. I mean, we're in Chicago. We own buildings in Chicago. We actually bought and sold a portfolio during the of manufactured housing during the pandemic.
The pandemic, wow.
Bought it, sold it, and made a nice return in a 10, 11-month holding period in north central Illinois, a suburban area. We still own a couple of office buildings in Chicago. Candidly, I probably wish we didn't own those, but we'll we'll see daylight one day. But we think there's plenty of activity here in the Southwest, and we're prepared to take advantage of it for a lot of reasons. It's hard to get things done in California, and we know how to get it done. And so when we get it done, we get well paid for it.
That's quite an advantage. We see now the continuing reports on, in various cities, how the capacity is back ramping up from the pandemic. I think Chicago is close to 50%. LA is right around there too. How long do you think it'll take before the general office market will get back to pre-pandemic levels, or will it ever? Some people are saying it won't.
I won't say it can't ever get there, but I think we got to work at ourselves. First of all, I think we are technically out of the pandemic and now into the endemic phase of COVID. I could tell you it's still impacting people because I have two people I know who got COVID this week.
Yeah.
And it's definitely impacting their lives in a not very fun way. Although their health issues were pretty de minimis, it impacts kind of just life and planning and things that you got to go do. Travel's still a hassle.
Sure.
You could get on an airplane if you had the flu. Now you can't get on an airplane with, and you wouldn't get on an airplane with COVID. So,
Right.
it changes that. I think it's, I'm not going to put a peg in the ground. I'll just say it's bigger than a bread box. It's
Okay.
It's not in the next 6 or 12 months. It's longer. I'll say this: we're going to have a recession before the office market recovers.
Okay.
Because we're going to have a recession relatively soon, in my mind. So
it seems like we already are in one. So we'll see what the quarter brings. The other really big issue for real estate, whether it be residential or any of the other categories, is interest rates. So, the Fed went all the way to zero, went up to $9 trillion on their balance sheet just to pump liquidity into the market. And now we're kind of in a box because we're looking at a possible recession, yet they need to raise interest rates to support off all the inflation because of that extra spending bill, like you mentioned, that they did, that really, in most people's mind, caused a lot of this. So now they're going to raise rates now 4 times, they say, at 50 basis points a crack. They bowed off the 75 basis point moves. So what will that do to real estate, and what categories could be hurt the most? Or is it just kind of a short-term thing and we don't really worry about it?
Well, I mean, my gut is it has to ultimately impact cap rates, which are, work inverse to values. So the question is whether cap rates go up and rates and rents go up and values stay the same. I think there's clearly we've seen a little bit of pullback on some trades at the margin, but it hasn't been in lockstep with the interest rate raises. I just talked to one of my broker friends about a large Amazon building that they had under contract at a 3.1 cap rate, which is a pretty aggressive cap rate.
Yeah.
And the buyer wanted to retrade to a 3.5, which I think historically we'd all be pretty happy with a 3.5. And the seller didn't take the retrade because it just felt too abrupt to them. But I'm not sure what their long-term prognosis is. Were they like we'd never seen a 3.5, and then we saw a 3.1, and then you see the 3.5 on the way back. And generally, what I know is you don't want to catch these things. You want to grab when it looks like a good trade, and what looked like a good trade, because a 3.5 cap rate is unheard of.
Right.
For me, I mean, look, I got in the market. You were buying 10 caps,
Right.
And then they went to 8s, and we all got astounded. So I think that you can have some disruption in the market. I think transaction volume is going to come way down. The last half of 2022 going to come to I won't say to a screeching halt, but I think transaction volume is going to fall pretty dramatically. But but the flip side of that, so I'm going to give the counter. There is so much capital in the marketplace looking for a home. Evidence this week, we think industrial values are high, but Prologis offered Duke a 30% premium for their portfolio, and Duke turned it down.
Wow.
So that would tell you that Duke believes values are higher intrinsically than their stock. So I think that people are saying, look, we're willing to ride through this bump. If you're properly levered, it's not going to be a problem. And I think for the housing market, I'm not really worried about the housing market. Look, we might have some pullback in pricing. I mean, if you had to put a number on it today, I'd say it's 0 to 10% pullback on pricing, but that's half of last year's gain.
Yeah,
we have. I think the count we have is 65% of the people are in mortgages that are below 4%. Yeah. They're not rate stressed. They're not in adjustable rate mortgages, and they got a job. So, and if they lose their job, they can rent their house and go get a cheaper house.
Right.
So I don't see this is not 2008 where we're going to get a 30 to 50% drop in home values. I just don't see it.
Okay.
Now, I always hesitate to say these things. These conversations are dangerous, Brian, because something that I've said, I'm going to regret that I said.
You heard it here, folks. You heard it here.
But I don't. I think if I own a house, I'm comfortable with my house, and if I don't have to sell, I don't sell.
Right.
I think what's going to happen is, and I think there's going to be so little in the resale market that it's going to keep pricing propped up for a while. You don't want to pay 6 because you could have paid 3 a year ago and you feel stupid. But if you need a house and you can afford a 6 rate, you're going to pay a 6 rate. I came into the market with 16% rates and still managed to sell houses. So, think about that.
I remember days, and that's when you're in Texas, I'm sure, right?
In Texas in the early 80s, and I was still able to sell a house with a 16% rate on it. Yeah, people needed shelter.
I remember car loans were 16% as well. So, this is really a great story. I really appreciate your sharing all investors, and any of the investors who are looking to invest with Shopoff, please talk to your financial advisor, hopefully here at 4-Star, and we can set you up with programs that would bring you the expertise of the Shopoff Group. Bill, when you think about the company you created and all the work you've done with investors, literally thousands of institutional and families and individual investors, is there any one theme that you think has led to your success as an organization and being such major players in the real estate market?
I think our tenacity.
Yeah.
It's the unwillingness to accept failure.
Okay.
And if the deal doesn't go as planned, to figure out a solution so that we can mitigate the damage. That doesn't mean we're not going to lose money. I can tell you, I mean, we've done over 1,000 deals. We've lost money occasionally.
Yeah.
But I think it's the tenacity to try to figure out tenacity, maybe ingenuity to figure out. I'm blessed. I have people like Daniel working with me, kind of making sure my compass stays aligned and helping direct me. And then I have some very brilliant people that have helped us execute. But it's willingness to think outside the box, and then an unwillingness to accept failure.
Nice. Well, it's usually leadership is the key, and being really committed to being a success at what you're doing, and you guys really are. So, any comments from you, Daniel, for your success?
I don't like to take any of Bill's thunder. He's both better looking and smarter than me, so I have to defer to him. But okay. I would add a couple things to what Bill said. I would agree tenacity and creativity, ingenuity are important. I would also say this is a company, when I first met Bill, what was attractive about it is a combination. Obviously, the track record's powerful. It's, you don't find at that time 22 years and whatever it was, 900 full cycle deals. You don't find companies that have been around for decades doing the same things successfully that don't know how to do it. But this company is great at not only discovering, I think what you call it, Bill, sometimes is turning the invisible visible. It's having an eye for understanding and seeing value where others don't, and then doing the hard work in advance of buying to mitigate risk. I think that is the two components that are critical are the ability, once you buy something, to effectuate it in a reasonable period of time and do so in a way that allows you to be flexible to ever-changing obstacles to get a job completed, which is what Bill's saying. But before you buy it, you can reduce the amount of times you have to go through the difficulties of that, or limit the variables by doing the right diligence in advance. And this is a company that looks through thousands of deals, negotiates on hundreds of deals, buys a very small number of them. And when they do buy them in advance of that, they pretty much know most of what could happen. Now, obviously, things can change, and they do. They always change. It's another thing you'll hear Bill say a lot is, the one thing he's sure of is nothing we ever project is correct, right? Because there's no such thing. You're not going to have a perfect crystal ball, but you can reduce the variables by doing the diligence in advance. And this is a company with really bright people, work really hard to minimize the variables once we get to the point where we're fully committed. And that combination of that and then the ability to execute are what makes this company special in an environment where we're not the only people playing the game, but we do a better job of it than pretty much everybody else.
Yes, and I believe that to be true. And we've met many different program sponsors, and in the support and development of our investors and their ability to do well in different categories in the alternative space. We've been fortunate enough, Daniel, as you know, and Bill, as you know, to meet some of the top people in the business like you guys. And so we're honored to meet you guys, to know you, and to be investors with you. And our investors are all the better for it as well. So thank you for being with us today on the 4 Stars Today's Market Explained podcast. And maybe we can check in with you guys again, in 6 months to a year, and we'll see if all the predictions we made actually come true, right?
That's always the scary part. Thank you very much, Brian. And I just want to, close with, we work with a lot of advisors. Your clients are fortunate. You're one of the top people in the industry, and the fact that you bring them great opportunities. Our interests are selfish. We love our product, but we know that you've got great opportunities for your clients, and they should be grateful for the relationship they have with you.
Yeah, thank you, Bill, and thanks so much for being with us today, you guys. Appreciate it.
Appreciate it.
All right. So, for the whole 4-Star team, we'll sign off for the day. We'll be back with another market commentary podcast, and that'll be interesting with what's going on even today, and then some other great interviews with another great set of professionals like Daniel and Bill. So thanks, everybody, and we'll call it for the day.